So the topic for today is decoding risk in an uncertain decade, I would say, right? I mean, all of us have seen the start of 2020, the pandemics, the wars, and whatnot is happening, right? And I want to pick the brains of these two industry veterans on how they are assessing risk in 2025 and how are they going about it all. So to begin with, I would request both of you to please introduce yourselves and share with us about the work that you guys are up to.
Okay. So I've been a consultant and in financial services for many years, and then I've been in the startup ecosystem probably longer than many of you are here, for 25 years. So I was helping startups to raise capital. Then I was the CEO of the incubator at IIT Bombay called Sign for 5 years. And then after a short stint at Hyderabad Angels, I set up Lead Angels along with a professor and a student. And now it is called Lead Invest. So we initially started as other angel network, but over a period of time, we've now diversified into helping syndicates to invest through our fund, which is a SEBI-registered AIF. I think Arthayan has also used our fund for some of their syndicates. We also help our investors. We have about 500 investors on our platform. We invest in pre-IPO shares like, NSE is pretty famous right now for the pre-IPO. And we also help our portfolio companies, which now number about 80, in raising capital or any other mentoring that we do. So that's the broad background. We are based out of Bombay, Bangalore and Chandigarh. That's our team.
Thank you. I think my experience is little lesser than Sushanto sir's, so this is my 19th year. Started my journey in Silicon Valley, building startups, and while building startups 2 years later, a GP comes in and I did not know what private equity was. I could barely spell. I was a hardcore chemical engineer, I still am. But things changed and suggested me to join on board as a partner. And I said, let alone MBA, I can barely know what DCF is. So I said, are you sure you want to drown and sink on the Titanic with me? I've never heard this good opportunity. And he said, well, you will see. I jumped, worked with the PE firm for almost 16, 18 years, buying distressed assets, turning them around. Parents used to say, don't go to courts, and here I am in courts fighting and getting all these assets and liquidation and bankruptcy assets. But started the journey from innovation, inventions and patents, building them into startups, and then committing my own capital somehow and working with this PE firm, and spent 18, 19 years, 3 years back, shifted my gears to do what I love and launched my own firm, Rate Ventures, which is largely cumulative learnings from Silicon Valley and Wall Street for 2 decades. Fortunately, was blessed enough to work with the right people and learn how they think and how they take decisions. So we do 2 things. One is investments, which we don't speak much about. We go both private, public. So we do that, and but very boring, and I'll tell you why later on. And second, which was organic, is institutional advisory. So we help the GPs, LPs, asset managers in Silicon Valley, Wall Street with transactions from VC side to private equity, hedge funds, or strategic investments. We do them all and we advise them. And good learning experience, more with failures than success. I know that sounds odd, but that's been the truth. They taught me a lot, and here to share my thoughts with you all on upcoming good questions. Thank you.
Thank you. We'll have a slot for the audience to ask questions as well. So I want to start by setting the context, right? Like, how would you see the I know it's a vague question, but how would you broadly see the risk landscape? What are the risks that you are if you were to categorize in, say, like an early stage founder, what all would you kind of see? Sushanto, if you would like to.
So I'll say that startup investing is risky, right? And the world is getting riskier. So I think we are all used to risk. And the interesting thing is that in such uncertain and risky environments, there is an opportunity for new startups to come up. We all know how COVID generated so many new startups. There were a couple of portfolio companies which were about to close down prior to COVID. And then during COVID, they actually bloomed. So, as they say, one man's meat is another man's poison, and vice versa. So, I think, we are seeing how defense startups are doing very well at this point of time. And I think, there is another COVID also lurking somewhere in the horizon, right? Beyond the horizon.
Yeah.
Beyond the horizon, I would say. But yes, so, health will be a major thing going forward. We can see how India has started having a lot of protein these days. So a lot of new things will happen, So I think from an entrepreneur perspective and investor perspective, not that we want war, but yeah, or COVID or anything, but these are actually opportunities. As they say, every problem is an opportunity for an entrepreneur as well as an investor. So I would look at it in a more positive way.
That's an interesting perspective. Gaurav, what are your thoughts on if you had to categorize risk? How would you see it?
Risk to me is no longer a spreadsheet variable. It's no longer traditional. It's investment is a function of founder pedigree, capital efficiency, time, and so on. Right? I think those metrics require a revisit or an introspection. I think what is more happening now with risk is it's a velocity of irrelevance. And what I mean is, invisible risks. Today we have Gen AI or ESG or things like this, supply chain weaponization. I mean, these, just like Sushanto said, there are unknowns and we don't know. Just a few days back, we saw Mark Zuckerberg is talking about scale AI and saying, I'm not doing enough. A corporate that is so deep into edge computing and AI is saying, I'm not. And it's not that they are not focused, but I think it is just that they are realizing that evolution and revolution both are happening parallelly, way faster than you can comprehend, right? So to us, risk is a function of these kinds of invisible risks that you are able to predict. It's no longer a spreadsheet variable, right? Managing those risks and being able to see beyond the founder pedigree, capital efficiency, time, or competitive landscape, right? I think that has become more critical than before.
Would you say has something changed from 2019 to 2025? Any thoughts on that? Or is it still the same?
I think the number of, in terms of how investors perceive risk or...
Yes.
So I think we are, till 2019, things were going on in the sense that the trends were much slower, whether it was e-commerce or it was e-learning or fintech. All these things were moving maybe far slower than they moved after COVID. Everybody started using Paytm and all those things started happening. So the pace of change has suddenly increased. And if I were to sort of look into the future, probably, the current political environment will also make changes happen far faster than they did. Manufacturing is one sector. It is suddenly going to change after this, what is happening all over the place, and whether it's Ukraine or it's Israel or whatever. Suddenly, every country, as you were saying, weaponization of supply chain, that is going to suddenly lead to a boom in local manufacturing, and we'll start forgetting about what we learned in our economics lessons, right? Where, of saying, which each country produces what it does best, and then exports it to the rest of the world. That might change, some magnets are now difficult to find, some rare earth, whatever. So those things will become. So if COVID sort of made the world flat, Zoom and Paytm and all those sort of stuff, e-commerce, e-learning, probably this is going to make manufacturing go back to being local and national, what used to happen before the 17th century, right? So we might move into, and that would be very interesting for, India becoming a manufacturing hub, not for one reason, but many reasons. It's not just about this, but, China plus one and so on. So I think that is probably the next area of change. Again, looking into the future.
If I were to summarize that, investors could previously take more time to analyze trends, but now they have to be on toes to see those faster changes happening.
Yeah. So how quickly has, quick commerce, the word is quick, they said quick commerce, but it's happened very fast, right? Before people could realize it's already happened. So that is what is the pace of change is speeding up. And then there are these, black swan events like COVID and the war. I hope it doesn't go beyond what it has. Yeah. But just in case, those will make humongous changes, as I see it.
Gaurav, what's your take? What's different?
So from an investment perspective, right? I think sectors, economies, they both are undergoing transition, as we are saying, right? From an investment perspective, I think we have added an angle of fragility mapping. And what I mean by that is founder patterns. What are their abilities to reinterpret failures? You are going to be surprised with whatever you do, especially you move into AI. We are talking about L4, L5 autonomies and robotics and all. I mean, things are changing faster than you can comprehend. Someone puts in billions of dollars and suddenly realizes that the GPS lidar based AI or agentic AI and robotic automation is all flat. I mean, entire money is gone. Some of the startups are gone. And someone with just few $1 million is coming up with synthetic data generation and others. And now the challenge is the beliefs of a founder, right? You spend 3-4 years, you convince investors, you build a model, you are working on that. And now you find a startup that is coming and saying, well, what you did is just wrong, right? Now, what's your ability to protect the investment? Are you going to stick to your beliefs that, no, Gaurav, I believed in this, I will do it? Or are you in a position to introspect that, no, look, someone is surprising me, I'd rather be humble and shift gears and do what is right. So I think we look into that fragility mapping, founder patterns, how they are thinking, their ability, their past failures, how they work through. And this is not something we did pre-COVID a lot, because like you said, I think it's right that evolution and revolution both were in different dimensions. I mean, when evolution was happening, it was predictable to a certain extent. Now, along with evolution and revolution, in other words, disruption used to be once in a lifetime, and now we are seeing it every few months, years, or something. And navigating through that is important. Previously, we used to see into the technology, innovation, competitive mode, right? Technical mode. And those things are still important, but I think there are new parameters that are added, and they are always going to be dynamic. So we have shifted those kinds of founder patterns and fragility mapping.
Any others, softer metrics that you have added on or you're focusing more on these days?
So, resilience used to be a softer metric, and now I think resilience is an integral component. With an example I just gave, right? That your ability to be resilient and be adaptable, to the changes, to recognize that what you are doing today may or may not be relevant tomorrow, right? Like I said earlier, the velocity of irrelevance is so high that the system and dynamics are asking, they are dictating, they are commanding. And when you go into some of these deep tech and these things, I mean, we just saw what DeepSeek did with ChatGPT, right. and it's just a very humble awakening as well for people that feel that billions and trillions have to go and then someone with engineers are coming in. So I think resilience and their adaptability to these kinds of transitions are those metrics that we continue to see. Right?
Sushanto, any others that you would?
Yeah, so we would, as investors and angel investors, look at the founder. But I think now, apart from all the economic things and financial things, the founder and the team has become very important, as he said, their resilience and their persistence and their ability to take failures. A lot of founders, in the past, I know I used to be in IIT Bombay, and these two com science grads set up a company. I'm just giving an example, I will not take the name. So they've been successful, right? You're a com science grad in IIT, or you're a successful guy. They set up a company. It was a gaming company. It was very successful. One of the first e-commerce. It was on e-commerce. It was an Indian board game, doing very well. The next venture, they set up something else, and it failed. And they just disappeared from the face of, so they could not take failure. So I think those entrepreneurs here, don't worry if your first or your second or your third venture fails, because resilience and persistence is very important. Right. And given how the world situation is, not just about you, how the world is changing, it's quite possible that your first, second, perhaps even third startup won't work. But don't give up.
Right. And has the due diligence process evolved or changed slightly, or is there something new that you guys are doing?
So I think two things. One is, of course, look more at the founder. I think also I would say corporate governance has become very important for investors, because it's a recurring problem it was a recurring problem in India, corporate governance, but it's now hit the startups pretty much. And we are very cognizant of the fact that, take ref checks and worry about what will happen if, things go bad. And so those sort of things, which again, we never thought of in the past. And I'm being, because we were all in a hurry to invest. We take our time now to invest when we look at, the founder and diligence.
Informational asymmetry, I think that's it.
But can you elaborate on that?
Yes. So, the standard due diligence is data room, then the technology mode, the sector, IRR stamps and others. I think now what's happening is it's becoming a little crowded space. And in that crowd, what's happening is people are jumping into the obvious. And that probably has its own risk and rewards, let's put it that way, in a neutral way. What we try to do is we try to find what's not known. And what's not known is probably a better way to invest in. When you are investing in a known dimension, you are obviously going to attract lots of competition. But your ability to price or see through the challenges of the sector, economy, and then finding a startup, if you view through the traditional lens, those startups will never make sense. They will always really feel like, no, this is not good, this is not possible. I always give a very classic example of Airbnb. When the founders went through the VC firms, almost 40 to 50 of the top best known VC firms were saying, this is not possible at all. Why would somebody rent your home? Why would I do it? I'm risking my own privacy, safety, everything. Why would I do it? And some of the investors have been kind enough to say that we couldn't see through the lens that he did. We couldn't. We regret missing out on this part because we knew his ability to do things. When you talk, you realize what an entrepreneur believes in. But we just thought that this is a risk that can not happen. There could be competition, there could be governance, corporate government laws, or something that could prevent. And I think these are the kinds of informational asymmetries that exist, and probably is a better way to your due diligence process, because if it is a function of your templates and guidelines, most of these good unicorns, as we call it as, will fall out of this template. It will require a lens and vision to see beyond the ordinary. And now, as I said, necessity I saw in the video he had is the mother of invention. Right? Yeah. When investment becomes so crowded, capital, liquidity, well, now liquidity is questionable, but right before the interest rates rose, was so available that raising capital wasn't difficult. We all have seen in COVID times how businesses' valuation metrics have increased. We used to wonder, paise aa kahan se rahe? Right? But we saw this, it wasn't an abnormal deviation, right? It was like not an anomaly, it was a pattern that was happening. But now that that is becoming crowded, we are also seeing now down rounds. Some companies are going through IPO and they are going through down round valuation of 30, 40, 50%. Klarna, I think, went through a down round of 85%. They realized that this losing 85 is better than 100, I guess.
Yeah.
And then they were practical about it. So I think one of the ways to do this now, moving forward, is pricing in the unknowns or finding the unknowns.
Fair enough. Now the next question is about like how can investors support founders to de-risk? Is there anything that investors can do in the whole equation? Is there a part that they can play?
So, of course, we would like the founders to de-risk. Right?
Yeah.
This is something which is, and so would the founders. But it's easier said than done. It's not so easy to do that. One of the things that I have seen is that the founder does not necessarily always listen to the investor. But if he or she can build an informal network of mentors to go to, saying, can I talk, if I have a legal problem. Regulation is a major issue, say for, not just for fintech, but for all startups. Can I speak to somebody? Rather than just going blind, and founders love going blind, right? They like going, okay, we'll figure out what happens. So have somebody to speak to. May not necessarily be your investor, fine. But having that infrastructure, I would say, has helped a lot of founders and successful ones to have that informal sort of network. Could be your uncle. You otherwise may not listen to your uncle, but for these matters, you should take his advice if he's from the domain that you're talking about, right? So that's the sort of thing I would suggest. Yeah.
This is a very great point, Malhar, and something that is up for intense debates. Okay, in my interaction with VCs and LPs, this is what I call it as founder capital parity. There used to be time, and there still is. Don't get me wrong, where startups just wanted to raise capital. They just looked at investment firms from a venture capital perspective. Now today we are in a time where we are looking for decoding capital. And probably who wants to be on my cap table. And what I mean by that is, one thing we have to agree that when founders succeed, they are lonely at the top. If you have built a startup and that succeeds overnight, the success is too difficult to manage. And there are mistakes that happen out of that unparalleled success. And those mistakes can be very painful. We saw some of the startups in India that went from 0 to 100, not 0 to 1, but it failed because of whatever reasons, the human characteristics that can drive. And I always say that now investment firms no longer can be in a space where you can just write checks. I think they need to be in a space where you can de-risk, help de-risk the startup. One of the problems also we have to acknowledge, and it's a part of the system, is the governance fatigue, right? It's a first-time founder. Startups, let alone startups, corporates are not perfect, they make mistakes. You cannot expect startups to be ideal. Utopia doesn't exist, except for dictionary. So, if that is the case, and we acknowledge that startups themselves are going through a learning curve, then where is the guidance going to come from? Is that startup founder going to get the feedback from the teams? Yes, but the likelihood of being receptive to it is also questionable. At the end of the day, they can either go to so-called big four firms or events where they can speak up. I think they in turn have a close connect with investors who are seeing them every other weekend, or who are seeing the progress of the company or the challenges of the company. They probably would be more receptive to that approach. So I think it's probably something that investment firms now have to step up from being a financial expert in writing checks to having that domain expertise that you can guide those founders from. It could be anything, right? It could be ethical blowbacks, it could be government regulations and policies. The founder himself or herself is surrounded by hundreds of tasks, milestones, from MVPs, if it is early stage, to beta, to customers, to teams, managing valuations, milestones, next round of funding. They sometimes are over involved. Even if in their sleep, they probably might be thinking something deep, right? And in that point, bringing in fresh perspective is important. So I call this as founder capital parity, where investors also have to evolve as well as startups evolve with all these technologies, and give them the right kind of guidance, right? Give them the guidance cannot be what competition is doing, what you are doing, what are your sales, and all. The guidance has to be very meaningful and in depth, to which they can feel like a eureka moment. That, yeah, Malad, this is fantastic. I missed this, but I'm now going to do that.
Right. So no, this was really helpful. Before I open it up for the audience, if they have any questions, like few fun questions that I could possibly ask you is that again, investors love risk on paper, but sometimes you also miss out on something. So is there a startup that came to pitch to you and you said no to them but regret it now, which keeps you up at night? Any stories like
keeps
that?
That keeps on happening. So and the startups you think that will not succeed, do. So that's the game. There've been multiple. So I can't think of one example.
So to live with it.
Yeah, to live with it.
Do spot pitch.
There are other ones.
And we said no.
So is it a save or not?
No, we were together in the past, so yes. So yes.
Any examples for you?
So two, one of them I cannot speak in public domain, but
this is friends and family.
I know. always.
She will switch on the camera.
Small fraternity. Yeah, if she can tell me it's off, I could. But no, 6 years back, there was this interesting technology that I saw, and I thought this is the future. It pertains to energy sector, and it was a call that I understood the patents. I myself, in an ethical sense, I'm saying it, so please don't misquote it. I reverse engineered it to see the depth of the innovation and the scalability. And I thought that this is it, right? This is the one you want to go after, and this will do well. And I come from energy sector, so that was another advantage. And for some reasons, when I, let's just say, saw something, I backed out. And I said, no, there seems the red flag is too high. Remember, if you're investing in a startup, it's an imperfect world. We acknowledge it. I myself built startups before going into this, so I come from that side of the world to understand it's not perfect. And I took that decision that no, I don't want to go, even though I think. Turns out that some of the VC firms have done it, and now they are sitting on 30 to 60x. And probably in about 3 to 4 years, the technology is going to get very, very popular. And some of those early players that are there, they still are around. They didn't win under. So that was one. And I regret it a lot. I mean, like I said, we all will have one of those days where we will pass it on and we realize, what did I do? What was I thinking? What was I smoking? Right? So that was one. The second one I could say, which was sector related, and it related to some public investments. When I saw this boom in the COVID time with data centers, right? That this is going on, and I had seen a little bit about LLMs with enterprise side. So ChatGPT came in November 2021. I saw something in 16, 17, 18, 19 when enterprises were using 3.5 and 12. And I realized that this is again energy guzzler. So I understood energy quite well, and I said, energy kahan se aayegi? Chips aa jayegi, NVIDIA aa jayega, energy kahan se aayegi? And right through that COVID, I saw this, and then I saw the US government announcing Inflation Reduction Act, and that pioneered more towards renewable energy. Because they need it, whether it comes from green hydrogen or this or that. And I knew that whatever renewable sources are available, solar, wind, geothermal is now picking up, and biofuels and others, or green hydrogen, it's not enough because the calculations, these guys need terawatts and these guys can barely go to gigawatt. And the missing link was nuclear. And I was very certain that after 20, 30, 40 years, this is a sector that will evolve. And